To start, market index performances for year-to-date 2025. As of September 15th. All right, world stock indexes featuring the FTSE Global All Cap Stock Index, which includes U.S. large, mid, and small cap stocks, as well as international developed and emerging market stocks. So it's a very broad measure. Also includes non-U.S. mid and small cap stocks, extremely broad. The broadest measure we can use, basically, is up 17.74% for the year. Now, breaking that down into its subcomponents, you can look at U.S. large cap stocks. Here we're using the S&P 500 Total Return Index, is up 13.54%. U.S. mid cap stocks, we're using the S&P Mid Cap 400 Total Return Index, up 6.22%. And U.S. small cap stocks using the S&P Small Cap 600 Index, up 3.64%. That is the worst performing asset type we're tracking on the board here for the year to date. Then we have international developed market stocks. So we're talking about the MSCI EAFE Index, which includes developed market stocks outside of the United States. So Western Europe, Australia, New Zealand, Canada, Japan, South Korea, etc. And that index is up 25.08%. So huge upside there. And even greater upside now, this is a shift from last month when we talked about this, is in the emerging markets stocks area, where we're now up 25.79%, which is the best performing asset type so far this year now. And that shift has occurred, it's basically switched places with international developed market stocks over the course of the last week or two. Looking at the area of bonds, we have U.S. short-term bonds. Here we're using the Bloomberg U.S. Aggregate 1 to 5 year Index, which includes corporate bonds, agencies, treasuries, etc., but all in the short maturity time period, up 5.09%. Then we have the broader U.S. Aggregate Bond Index, again, a Bloomberg U.S. Aggregate Bond Index, up 6.63%. So that's including not just the shorter time period bonds, but also out to 30 years even, with corporates, agencies, treasuries, etc. But these are U.S. bonds, right? Up 6.63. And then we're looking at Treasury inflation protected securities in the United States, up 7.41%. So that's in terms of bond types, that's the best performing bond type so far this year. And that actually, has also been a shift really over the last 2 weeks or so. If you had looked at this a month ago, most of these would have been, still middle, single-digit returns, but 5% or below for the most part. Now we're 5% or above, so we've seen a bump up there. Partially in terms of expectations for an interest rate change, an interest rate drop by the Federal Reserve, which actually was confirmed yesterday. There was a 25 basis point drop that was announced yesterday, but that was already priced into the market effectively. Okay, so that is where we stand for year-to-date 2025. But looking back, and we can talk about, like as we did last month, a little bit about the pretty stark differential in the United States between large and small cap stocks, and also the stark differential between the performance of stocks inside the United States versus outside the United States. A lot of this has to do with the dollar, has to do with tariffs, has to do with international trade, etc. We can come back to that later if anybody has any interest. Okay, moving forward. Mick, if you can pan over this way. Okay, so if we look at the performance of the S&P 500 index over the last couple of years, right? This gives us some insight as to what we might expect going forward. So that's why we're going to look at this. This is what we call our historical market type data analysis. Right, so going back all the way to January 4th of 2022, right, this was the peak of the prior bull market that followed the coronavirus bear market. And It was also the start of the next bear market, right, which lasted from January 4th of 2022 until October 13th of 2022. At that point, you never really know, and I'll preface this whole conversation by, you never know what type of market environment you are in until typically long after it's already over, right? After it has been confirmed in arrears, right? So in this particular case, after the bear market, you never know you're out of a bear market until you re-achieve your prior record price, which would be the prior record price from January 4th of 2022. That did not occur until January 19th of 2024. So at that point, that's what we call a bull indication. We know that this was the bear bottom, the trough of this bear market, and that January 19th, 2024 date was the indication that we know we have been in a bull market since that trough on October 13th, all right, if that makes sense. Now, what also happened in the interim period before we even knew we were in a bull market is we experienced something we call a wolf market. By our definition, a wolf market is a correction of 10% or greater from the most recent record peak, right? But not more than 20%, plus the recovery back to the pre-correction price, peak price. So that occurred from July 27th of 2023. There was a peak, we had a trough, and then we recovered to the prior peak price on December 8th of 2023. So that's an example of something we call a wolf market, right? Okay, looking forward from January 19th of 2024, we then continued this bull market, and on February 19th of 2025 of this year, right, we achieved a new record peak, right? And at that point, we did not know what was coming up, whether that was going to be a correction or a bear market. We had been expecting during this time period that there would likely be a correction coming up of 10% or greater, but not 20%, right? And the reason for that is because if we look at the history of, if you can scan over, Mick, and just kind of zoom in a little bit to the degree you can. If you look at the history of bull markets from 1950 until 2020, right, which is the data set on which that we're looking at here, on which we're basing these assessments. Bull markets from trough to peak, so from in this example, October 13th of 2022 until the peak, right? They range from 1.15 years to 9.55 years, right, in terms of the historical ranges, with an average of 4.29 years, right? In that particular case, and oh, by the way, so we also would expect a range of gains of 44.62% to positive 341.05%, with an average of 133.09%, right? In that particular case, up to that point, we had only seen a period of gains of 2.35 years and 76.06%. So based on that data from trough to peak, you were roughly halfway through an average bull market. All right. So the expectation was that, furthermore, that during bull markets, a subcomponent of most bull markets is something we call this wolf market. And in most bull markets, you see an average of 2 to 3, right? Wolf markets intervening before you see a new bear market. In this particular case, we only saw one wolf market. So all signs were pointing to a correction of 10% or greater, but not 20%, right? So within that range. What we got instead, following February 19th of 2025, we hit the 10% decline mark, cumulative decline mark, on March 11th of 2025, and then on April 7th of this year, we hit the 20% decline mark, so on an intraday basis. but not on a closing price basis, interestingly enough. So basically what happened, on the same day that the 20% decline mark was hit, and actually the maximum decline was 21.35% on April 7th, a bear market was indicated, we breached the 20% threshold, and then we actually turned around. That turned out to be the trough on the same day on an intraday basis. So the S&P 500 never closed down more than 20%, but on an intraday basis, it closed down 21.35%. So depending on which definition you use, that was either a correction or a bear market, right? So by our definition, on all this, all the data analysis we use uses intraday data. So looking at it from that perspective, this was indeed a bear market, albeit a very shallow one, right, compared to most in history. It also turned around as fast as any other bear market in history, right? So there have been other bear markets that turn around on the same day as well, right, or the day following even, right? So, or even the month following, right? So that's actually relatively common. So this is I use the term sometimes, the term bear cub. It's like a small bear market as opposed to a big boar bear, right? There's basically two different types if you look at the historical data on this. Two relatively identifiable extremes, right? So this is on the lower end, the shorter end of the bear market. From that point forward, again, same as what I talked about back here. You don't know you're out of a bear market until you re-achieve the prior record price, right? So that happened on June 27th over the summer of this year, right? June 27th, 2025, we re-achieved the prior record price from February 19th of 2025. This was an extremely rapid and steep recovery, right? So relatively unusual, right? It has similar things have happened before, but this is definitely one of the fastest recoveries in financial market history. Again, very much on the shorter end, right? Now, what has happened since then, so we have, again, what we call a point of bull indication. Now we knew, at this point we knew, okay, we had been in a bull market. Two things were recognized. Number one, that this was the trough of the bear market on April 7th, and secondarily, that we now know we have been in a bull market since April 7th. Right? So two things confirmed at the same time. From that point forward until now, so from June 27th until Monday, the 15th, and again, as of right now, the market is again up today, so really up through today as well. We know we have been in a bull market, not in any other type, except for potentially an eagle market, which I can get to later. So up through the 15th, or up through today at least, up to the 15th, we had seen additional cumulative gains since the point of bull indication of another 2.67 months and an additional 7.61%. So this number has actually come up slightly as of today, right? So it's probably closer to 8% today. And that's since June 27th. Now, if we look at from back, cumulatively since the trough on April 7th, we're talking about an additional 5.37 months and an additional 36.82% since the trough. Okay, so let's compare that over here to, again, financial market history, if we look at the history of bull markets, right? So bulls from trough to peak, again, the average is 4.29 years. So far, we've only seen 5.37 months, right? The average is an additional gain of 133.09%. So far, we've only seen 36.82. Alternatively, if we look at it from the point of bull indication until the next peak before a bear market, the range is from an additional 6 days to an additional 7.44 years, and the average is 2.44 years. In terms of returns, it ranges from a positive 2.09% to a positive 225.74%, right? With an average of 52.53. So far, we've only seen 2.67 months and a positive 7.61%. So if you look at both of those things together, based on history, although anything can happen, of course, right? The averages can change. We could end up with a situation that changes the extremes referenced historically here as well. That's also possible. But it is extremely unlikely that would be the case, right? Again, based on history, based on the averages, based on the extremes, right? So it's very likely, based on that assessment, that we are in the very early stages of a new bull market. So that is good news for stock investors as well as for bond investors, I might say. Okay. Now, there are caveats to this, right, in terms of what expectations should be going forward. Mick, if you just warn me when we need to pause.
Just 15 minutes.
Okay, so what else do we know? So another thing that we know about the history, so far we've really just spoken about bear markets and bull markets, but the other types of markets that I've alluded to here, or I've talked about real briefly, is the wolf market and also something called the eagle market. All right, so the wolf market is, again, this period of correction of 10% or greater, but not 20%, plus the return back to the pre-record price. So it's kind of a V-shaped market environment. Then you have something we call an eagle market, one of which occurred from December 8th of 2023 until December 23rd of 2024, which is a period conceptually, it's a period of rapidly rising or soaring asset prices with low volatility, right? And from a quantitative standpoint, it's a period of trailing returns of 30% or greater with no intervening 10% plus correction, right? So that's what we saw here. And both wolf markets and eagle markets are subcomponents of the more traditionally defined bull market, right? So they're pieces of the larger bull market puzzle, so to speak, right? Okay, so with wolf markets, as I mentioned before, this is what we need to consider. So if you could just pan over this way, Mick. So historically, we can look at primarily what we're going to look at the time period and the number of wolf markets that occur during the course of prior historical bull markets. And if we look at that, again, looking back at the history since 1950, then the average, I don't have that listed up here, but you have an average of between 2 and 3 wolf markets that intervene during the course of any bull market before a new bear market begins. Right? So far, we have seen 0. There's actually only been one time in history where there's been no intervening wolf market between bear markets, and that was very recently in the period between the 2018 bear market and the 2020 bear market. That was the only instance in the history of the S&P 500 where there was no intervening wolf market. All of the other ones have had at least one intervening wolf market, and up to 5 or even 6 wolf markets, right, have occurred before a new bear market occurred. So far, we have 0, right? So that's good news. However, if we look at the average time between either the trough of a bear or a wolf market and the peak preceding a new wolf or bear market, so a downturn, right? That ranges from, at the extremes, from 1 day, right, to 5.62 years, with the average being 1.14 years, right? So thinking of it from that standpoint, if we go by the average, then if we look at this as the most recent trough, which it is, on April 7th, then if the average is 1.14 years, we're talking about sometime in early to mid 2026, we should expect some kind of 10% plus correction, right? But not more than 20%. Again, just based on averages. Which means that, and not another thing that's not here up on the board though, but they should be aware of, if you look at the history of the of all the different wolf markets that have occurred, and which is these 10% plus corrections and the recovery, they tend to cluster around the 6 month after indication and 1 year after indication, or a trough. I should say, when I say indication, should actually, I misspoke. And anywhere from 6 months after a trough to 1 year after a trough is where most of these occur, right? I had mentioned the extremes out here, but they tend to cluster around the average, right? It's more of like a normal distribution curve as opposed to like a fat-tailed or a leptokurtic or a platykurtic distribution curve. So it's more of a normal distribution curve, which means that sometime over, and we're now, again, 5.37 months after this. So we're coming up on that 6 month mark, which means that we should consider that at some point over the next year, we're likely to have some kind of 10% plus correction, if that makes sense. Okay. Now this is not, I would tell you, that particular point is not necessarily something that individual investors or our clients should be concerned about, but it is something that we as portfolio managers at 4Thought or other advisors or other portfolio managers should be concerned about in terms of how they manipulate their clients' portfolios. Right, so that's something to consider. It's not something that for the investor to be, or the clients to get stressed about. It's something for us to think about and to act on. Okay, so what does all this mean? Well, there's more to it actually before I get there. One other way that we look at market, if you could pan over here a little bit, Mick, please. If we look at analyses of markets and asset types, another thing we do is probabilistic analysis. This is a quantitative method of analysis where, again, I mentioned distribution curves. So instead of simply looking at historical market type data analysis like we did over here, another thing we do is we look at something like the asset classes that I mentioned earlier that we reviewed from year to date, and we create probability distribution curves for each of those asset types every day. And the outcome of that analysis tells us whether those asset types are overvalued or undervalued or fair valued, and how much so. Not just on an absolute basis, right, but also relative to other asset types. And when we do that analysis, again, which we do every morning based on the prior day's data, we find that as of now, stocks of most types, right, including all the ones we show up here, are ranging from near fair value to moderately overvalued. And when I say moderately overvalued, that is 1 standard deviation or greater above their long-term average. Right? Bonds are ranging from slightly undervalued or cheap to slightly overvalued or expensive. Right? And when, by our definition, slightly undervalued would be from negative 0.5 standard deviations, right, to 0, and slightly overvalued would be from 0 to positive 0.5 standard deviations around the mean. So bonds are, pretty close, they to the long-term averages, whereas stocks are looking slightly, above long-term averages overall, I would say, or near fair value, right? So not too extreme, but above average, right? Okay. So just to recap, to summarize, we saw this bear market trough on April 7th of 2025, which also turned out to be as the same day it was indicated. That also turned out to be the trough on the same day. The bear market was confirmed on an intraday basis, but not a closing price basis, right? So if you measure just using data on a closing price, you would call that a correction. Right, it would be a big correction of almost 20%, but it would not have breached the 20% threshold. Or if you measure on an intraday basis, then you get negative 21.35%. So it is a bear market. So depending on who you ask, this is either a correction or a bear market, right? So it's borderline. And then we have a bull market confirmed on June 27th of 2025. So what's interesting about that, and the reason I make the differentiation between intraday basis and closing price basis, is that even if you looked at this, you didn't use the intraday basis analysis and you went on a closing price basis analysis, even if you did that, we'd still be, if we looked at, and we assumed we're still in the bull market that started on October 13th of 2022, we'd still only be, let's call it 3 years into this bull market, whereas the average length of a bull market is 4.29 years, right? So we'd still be less than the average length of a bull market, right? So the likelihood of a near-term downturn is still relatively low. We'd still only be about 3/4 of a way through a bull market, even in a sub-optimal scenario where you're talking about the bull market started down here as opposed to way up here, right? So that's all positive for the most part. But, and lastly, the wolf market scenario where we see a correction of 10% or greater and then a recovery, right, is becoming more probable as we progress over the next 12 months, right? Basically starting now and over the next 12 months, things will become more, as we progress, as time elapses, it will be more and more likely that we will be witnessing a correction of 10% plus a recovery, right? So that is, all of that frames what we should be doing with investor portfolios, and that's what we'll talk about over here. So what is the overall outcome here, and actions that can be taken? All right, so just kind of reiterate, based on the aggregate of our probabilistic analysis and our historical market tape data analysis, we are looking at a stock market outlook that is neutral, right, to slightly positive, right, which is the more likely scenario. The slightly positive scenario is more likely. What does that mean? As you would, I kind of, iterated here already, you want to maintain a neutral to slightly positive stance in terms of the allocation of your portfolio, but start preparing for a wolf market in the next 12 months, sometime over the course of the next 12 months. Okay. One thing we didn't really talk about, most of you that have seen me do this type of analysis before will recognize that each of the 4 different market environments I talked about here, bear, bull, wolf, and eagle, actually has a different type of investment method that tends to outperform the other methods during those time periods. All right, so whereas during a bear market, liability-driven investing tends to outperform, in a bull market, strategic asset allocation tends to outperform. In a wolf market, opportunistic investing tends to outperform. And in an eagle market, selective or concentrated investing tends to outperform historically. And just to give you a quick recap, so liability-driven investing, the one that is associated with bear markets, is used by large institutions like insurance companies, banks, public pensions, and what it entails is typically you're talking about using fixed income instruments or derivative instruments or insurance products to transfer risk to another party to insure yourself against market decline, right? So that's, in a nutshell, what liability-driven investing is. You quantify your risks and liabilities and find a directly offsetting asset to transfer the risk to another party, right? Then you have strategic asset allocation, which does best in bull markets, and that entails what most people are familiar with, most advisors are familiar with, which is modern portfolio theory. You build a diversified portfolio of different types of asset classes or subclasses. You set a percentage allocation split between those, and you rebalance back to that split over time, really only making changes to the investor portfolio based on changes on that individual investors or institutional investors' life cycle, right? Their objectives, their risk tolerance, etc. You're not really reacting to the markets necessarily. You're just basically sticking to the allocation and adapting the allocation as to the investors' needs, right? Not to the markets. Then you have opportunistic investing, which does the best in wolf markets. So opportunistic investing, think about things like hedge funds or tactical asset allocation or unconstrained portfolio management, where the portfolio can be manipulated and actively shifted in response to market changes or in anticipation of market changes. And that tends to have the ability to outperform in specifically in wolf markets, because it at least has the capacity or capability to capitalize on volatility, as opposed to being a victim of it like all the other methods typically are, right? All right. It's very difficult to apply, but it is at least has the potential to do that, right? Which the others don't, right? And then you have the selective or concentrated investing, which does the best in eagle markets. And selective concentrated investing is the idea of, think of like private equity funds, value style stock investing, growth style stock investing, or somebody like Warren Buffett, right? Where they really don't care about diversity or risk transfer or tactical portfolio manipulation. They just want to know as much as they can about the select portfolio of companies or securities they're invested in, and they want to manage those positions accordingly. All right, so that tends to do best in eagle market environments. Okay, so I had to give that brief explanation so that you understand what I'm talking about next, which is what to overweight or underweight in terms of these methods of investing right now, based on this analysis. If we come over here, Mick. Okay, given that we need to start preparing for a potential wolf market over the next year or so, we will start to, not to drastically overweight, but to allow existing overweights or create small weightings to opportunistic investing, right? To gradually increase the weighting to opportunistic investing over the course of the next year, right? We were allowing underweights to selective or concentrated investing, because we don't necessarily expect that to be the dominant paradigm, because that typically follows a wolf market, and we have not just had one. Now, one caveat could be that if you consider this is kind of right on the borderline of a wolf market versus a bear market in its recovery. So it could end up that we end up in an eagle market coming out of this. That is very possible. If so, I'm not necessarily worried about missing it, because that's not normally when they occur. They normally occur following wolf markets. All right. So we're underweighting selective or concentrated investing. And we are neutral on strategic asset allocation and liability-driven investing. Because basically, whatever your allocation should be as an investor right now, in terms of your long-term allocation between liability-driven investing, which is primarily bond-heavy, and strategic asset allocation, which tends to be primarily stock-heavy, whatever that allocation split is you should maintain at this point, right? There's not necessarily a big need to overweight or underweight one or the other. You should take a neutral position on that based on whatever your particular tolerance for risk is and your objectives are. So no reason to drastically make any shifts there. So that's the reasoning. Okay, if we get a little bit more granular in terms of asset type valuations, we have, right now we're looking at, as of this morning actually, long-term U.S. Treasury bonds in the United States look the cheapest relative to the other types of assets out there, whereas emerging market stocks look the most expensive. Now, that doesn't mean I think you should rejigger your client's portfolio based on that, but it's something to consider. If you need to rebalance out of one thing or into something else, those are things to consider. Also, I would note that neither of these are at any extreme level where it's a big concern at this point. So, for example, long-term U.S. Treasury, there's about 0.6 of a standard deviation below its long-term average, whereas emerging market stocks are just over 1 standard deviation over the long-term averages. So neither of these are very extreme. If you start getting into the 2 standard deviation range and above, now you're looking at more extreme valuations, and neither of these fit that bill, nor do any other of the asset types that are out there right now that we're tracking. Okay, so what else can we do in terms of what can the investor do right now, or how can you advise your clients, or how would you like us to advise your clients, right, if you're an accountant? So talk about two different types of investors. Growth investors, who are still in the accumulation phase. They're still saving for retirement. They don't need any income from their portfolio right now. Then we'll talk about income investors. These are people who are, usually this would be somebody who's in retirement. They're taking withdrawals from their portfolio to supplement their income that they may receive elsewhere from Social Security or pensions or real estate, whatever else whatever other income they may have. They're withdrawing money from their portfolio, right? So for growth investors, it's pretty simple. You want to be neutral on your systematic investments. Right, so if you're putting into your 401k plan, you're putting into a taxable account, or you're saving into college savings plans for your kids' future education, then you want to be neutral in terms of the amount you put in there. What I mean by neutral is you want to do an analysis of what your income is, separate out taxes, separate out your living expenses, right, or subtract them out, and whatever is left over is your annual savings, right? And that is the number that you can divide by 12 and put it in on a monthly basis in your portfolio. And I would stick to that number. I would not put in more than that or less than that, right? Neutral, right? There are times that we will recommend that people put in more or less than that. This is not that time, right? Neutral is the way to go. Also, I would note that because of the fact that even though we are at record highs, so to speak, in terms of stock prices, we are still usually, if you look at the history of markets, we are usually at record highs. It's rare that we're not at record highs. The only time we're not at record highs is we're in these troughs during bear markets or wolf markets. Most of the time the market is rising, you're re-achieving new records. That's the nature of the stock market, especially in the United States, at least historically. That being the case, you do not have to be worried about deploying cash right now. If you have excess cash on the sidelines that you do not need for short-term expenses or for your cash safety liquidity fund of 3 to 6 months of income, or living expenses, I should say, and it's not needed for an upcoming cash layout for any kind of home purchase or buying a car or anything like that, you should not be concerned about deploying that cash into your investable portfolio right now. Deploy it. There's no reason to wait on that. On the flip side of things, for income investors, very similarly, you want to be neutral on your withdrawals. Doing that same analysis I mentioned before, where you take it's kind of the same analysis, but in reverse, right, for income investors. You're talking about what is your income need, right? Determine how much you are getting and what you're paying in taxes, determine how much, what you're getting in terms of income sources, non-portfolio income sources, and whatever is left over at the end is what you need to withdraw from your portfolio on an annual basis. Divide that number by 12, and that's what you need to withdraw on a monthly basis, right, from the portfolio. That's a little bit oversimplified, but that's in concept what we're talking about, right? That, again, should be a neutral number. So whatever that simple analysis, the output of that analysis is, your monthly withdrawal should be that number. It should not be any more or less than that. As I mentioned earlier, there are times when we would say it should be more or less. This is not one of them. Be neutral, right? Again, for income investors, kind of the inverse of with growth investors, is that same thing in terms of cash deployment or taking cash gains, right? The only time that this is not a time period to be concerned about taking gains. However, if during the time period, during this bear market, you had taken our advice during this time period and had reduced your withdrawals, right, and lived off a portion of your cash safety liquidity fund during that time to supplement your living expenses, to keep as much of your assets in the market as possible while the market is down, so that you can capitalize on the upside when it came, and it came pretty dang quickly. So if you had done that, you may be a little bit short on cash, on your cash safety liquidity fund right now. This would be a good time to top that up, not to take out a big chunk to say, oh, we're preparing for some, big downturn, nothing like that. Just to make sure that you have your minimal level of cash necessary, again, to cover your cash safety liquidity fund, to cover any upcoming short-term expenses. That's all. All right, there's nothing extreme there in any way. So that, in effect, is the net of the analysis, and I hope you find it useful. Just as always, I just want to give a quick commercial for those of you who are not totally familiar with what we do. At 4Thought Financial Group, we are an independent SEC registered investment advisor. We are not owned by any other company. Nobody tells us what to do. Nobody tells us what to tell our clients. We're independent. That makes us much less biased and much more objective when we're working with a clientele. And there are three main services we provide. All right, we do investment management or investment portfolio management services in terms of managing separately managed accounts. We run 10 different strategies that we mix and match for your clients. We are rated and ranked by Morningstar. Right now we have, we have 2 5-star overall rated strategies. We have, 5 4-star rated strategies, if I'm not mistaken, and 3 3-star rated. So, and those are out of 5. So we have nothing below 3 stars. So we were really doing extremely well for our clients over the last several years. And so that's our investment portfolio management services. Then we also offer, as an adjunct to that, retirement plan services. So we act as the investment advisor as well as the record keeper, and we actively install and manage 401k profit sharing and defined benefit plans for your clients. And we use our own proprietary separately managed account strategies, the ones I just mentioned, to manage those for those plan participants. And then lastly, we perform retainer fee-based financial planning services and comprehensive wealth management services, where we do not just the things I just mentioned, but also estate planning, business succession planning, fringe benefits, and of course investment planning, like the retirement planning that Morty and Dan just spoke about earlier. All right, so to the degree we can help you with your clientele, we would very much appreciate referrals for those purposes. And if you'd like to discuss that beforehand, please give us a shout. And thank you very much.